All right, I think we're ready to get started. We want to try to be on time here. So thanks all again so much for coming to our panel titled The Limits and Reforms of Insurance Under Shifting Climate Risk. This panel is designed to showcase innovative research and knowledge sharing from earlier career academics and practitioners at the forefront of many of these issues around insurance nationally. My name is Emelina, and I'm a graduate student in city and regional planning at UC Berkeley with about 5 years under my belt, building observation-based flood monitoring systems for both the parametric flood insurance industry and public disaster agencies. And I'm joined by my co-moderators, Hannah and Alex, here virtually. So I just want to give them a chance to introduce themselves.
Hi, everyone. Thanks so much for coming. My name is Hannah Friedrich. I'm a PhD student in geography at the University of Arizona, interested in looking at the intersections of disaster recovery and insurance. And Alex, if you're online and you want to introduce yourself.
Hi, everyone. I hope you can hear me okay. Please feel free to stop me if not. Yeah, it's great to join the session today. Sorry I can't be there in person. My name's Alex Saunders. Like Hannah, I'm studying at the University of Arizona. I'm interested in risk financing, particularly where insurance can improve the outcomes for flood recovery. I'll also be monitoring the online chat and Q&A in today's session. Thanks.
Great. So just as a brief introduction, while insurance is not a topic that is widely popular at the Management Industry Conference, as mitigating future risk becomes a central priority for governing bodies, insurance and reinsurance will play a massive role in influencing how the effects of climate change are distributed all over the country. After an already troubling start to the summer, we've already seen the effects that these recent more frequent and more severe disasters fueled by climate change have signals about the health of this broader industry. So just some examples from recent news. A few weeks ago, we saw three of California's largest insurers announce they will no longer be accepting new home insurance policies, citing increasing levels of catastrophic exposure from disasters like wildfires in particular, already following several years of restricting coverage and attempting to raise rates across the state. In Florida, an insurance crisis has led national carriers to pull back from the market, with local regional carriers with smaller financial reserves jumping to fill the gap. However, as we saw last year with Hurricane Ian, this marked the costliest hurricane in Florida's history, with over $100 billion in damages, pushing many of these companies to slash payouts far below damage estimates. So considering these fundamental issues and pricing uncertainty while facing rising risks, adaptation pathways and opportunities for reform must inevitably look different in the coming decades, regarding the future of insurance as a tool for disaster management writ large, from the health of the housing market to changes in land use and place-based industries, as well as human displacement and migration. So I'll hand it to the goal of the session.
Yeah, so this panel is really motivated by these questions of where does the insurance industry go from here and continue to operate as a solvent guarantor of protection in the face of these more routine extreme losses. And our specific interest in organizing a panel on this topic at a conference on managed retreat and with the theme of habitability stems from recognizing the inextricable links between insurance and safe and affordable housing, and importantly, how these increasingly worrying trends in the insurance industry is acting as a bellwether of how habitable a certain location may be and the various equity implications this has for groups who both can and cannot afford and access insurance. So to address this topic, we've invited speakers to discuss potential policy and planning reforms and limits of reforms for insurance to reduce and distribute risk in ways that do not create or exacerbate existing inequalities in affordability and access, as well as how this spills over into housing, migration, and actions to mitigate hazards for future events. So as stated in the title, this is an early career panel, and speaking on behalf of myself and my co-chairs, we kind of selfishly organized the session to hear from some fellow researchers who are just a step ahead of us in their research and career path, to give us some insightful insights on the state of the insurance industry, as well as some innovations happening in the space. So we have a fantastic lineup of folks speaking today. We'll be hearing from Jacob Pratt from Harvard University, Ian Gray from the École des Études des Sciences Sociales, Clay Kirchhoff from the California Department of Housing and Community Development, and Rachel Young, who's joining us in person from Princeton. So the kind of run of how this will be structured is that we have 60 minutes for presentations. Each speaker will speak for about 10 minutes, followed by 5 minutes of Q&A, and then we'll close the session with a group discussion, and then we'll welcome questions from the audience as well. So without further ado, I'll pass it over to our first speaker, Jacob Pratt.
Great. Well, thank you, everyone. Hopefully you can see my screen. Great. All right. Well, first, a big thank you to the organizers, the session, Hannah, Alex, and Emelina for bringing this all together. Of course, the conference organizers as well. As you just heard, my name is Jacob Pratt. I'm a PhD candidate at Harvard and an energy and environmental economist by training. I'm going to go ahead and jump in a couple of remarks keeping it at kind of a high level on my thoughts on the prospects for various reforms in the insurance industry. But to start, it's likely unnecessary context for a conference on managed retreat, but I think it bears repeating that we've probably reached a key turning point in the market for insurance, where climate risk is really here to stay. As you can see from the figure I'm showing you here, recent years have seen a pretty dramatic increase in particularly costly natural disasters. As you can see, we've now had actually, a few years in a row recently where we've had around 20 natural disasters per year with damages exceeding $1 billion in the US. Looking back historically, that actually represents a six-fold increase from the early 1980s. So as you might expect, insurers are certainly taking note of this trend. Homeowners insurance premiums rose around 40% nationwide from 2010 to 2019. And this is a trend that, as you can see here, is likely to continue. Perhaps more troubling from a public policy perspective, we've also seen, as already been alluded to, an increase in the number of insurers that are exiting certain markets, which is pushing households into state-backed fair insurance plans. To put some numbers on this, from 2018 to 2021, the number of enrollees in state fair plans, which we can think of as sort of insurers of last resort, rose around 30% nationwide. So these trends in the insurance market, which I think are alone, quite troubling, have impacts not only on households directly affected by higher premiums and shrinking marketplaces, but also on adjacent markets and the broader economy. So we can think of this, I'm stealing from Dr. Ben Keyes at Wharton, this idea that insurance markets here are really operating as the canary in the coal mine. So some examples here, there's extensive research that documents that higher flood insurance premiums actually lowers home prices and makes it more difficult for households to get mortgages. There's also an even large or growing body of research that is documenting that housing markets are beginning to price in exposure to future sea level rise as households are trying to avoid uninsured losses. So these spillovers are also by no means limited to housing markets. My own research with Jesse Keenan at Tulane University shows how physical risks affecting the housing market can spill over into the mortgage market and broader financial system. So what Jesse and I did, we focused in particular on coastal housing markets in the southeastern US, and we explored the impact of long-term dynamics in flood exposure, so sea level rise, on residential mortgage lending behavior. At a high level, what we find is that conditional on the size of a lender, which we measure using a notion of geographic diversification, we found a pretty meaningful relationship between how exposed an area is to future sea level rise and the share of mortgages that lenders are maintaining on their balance sheets. So that's what I'm showing you here. On the x-axis, from left to right, we're seeing increasing geographic concentration. On the y-axis, from bottom to top, we're seeing increasing exposure of a given area to future sea level rise. And what you can see on the right-hand side is that these concentrated lenders are far more responsive in their their retention behavior of loans that they're originating to sea level rise exposure. And that begs the question of where these lenders are sending their highly exposed loan portfolios. More often than not, we find that they're going to the government-sponsored enterprises, Fannie Mae and Freddie Mac, and as a result, ultimately to the U.S. taxpayer, which presents a pretty substantial risk management challenge for federal regulators and policymakers. So now, taking stock of these troubling trends, thinking about what it means for the purpose of the panel, insurance reform, there are two pretty dramatic shifts that I've mentioned ongoing in several insurance markets of rising premiums and unprecedented insurer exit. I'm actually going to argue that the latter is perhaps the most troubling trend here. So when existing private insurance markets unravel, it's policymakers who are acting as a backstop in these state-backed FAIR plans, as we've seen, as you can see here, which have in a couple of states, California and Florida in particular in recent years, risen in size quite dramatically. And this presents a pretty major fiscal solvency challenge for policymakers. Thinking about potential reforms, asking the question, how can we stop these private insurance markets from unraveling? I'm going to present two relatively basic suggestions. Neither of these are going to be terribly earth-shattering, but I think it's important to think through why they're necessary in this setting. The first is going to be actuarially fair pricing. It turns out that in a lot of the contexts where we're seeing high-profile exits of insurers, such as the ones that were alluded to at the start of the session, they're pretty substantial barriers to raising premiums to reflect changing risks. In California, for example, it's Proposition 103, which was passed in 1988, I believe. And this requires insurance companies to get approval from the Department of Insurance to make changes to property and casualty insurance rates exceeding, I think, around 7%. And so the objective of this is to ensure consumers aren't paying more than they should, and that's certainly quite important. However, the system in place under Proposition 103 does present a major barrier to insurers raising rates, leaving rates artificially low relative to the risks that insurers are taking on. And as a result, unsurprisingly, we're seeing a lot of high-profile exits in this particular market. So, risk rating insurance premiums is important to not only help insurers cover losses and remain active in a given marketplace and avoid this sort of unraveling and ballooning of these state fair plans, but risk rating can also serve as both a financial incentive and informational adaptation signal to households. So if we think about rates actually reflecting households' true risk of loss, then we should expect naturally households to respond accordingly and make insurance and adaptation decisions accordingly. But it's important to note price signals alone aren't necessarily enough here. While actuarially fair pricing is perhaps necessary, it's by no means sufficient in terms of reforming insurance markets and addressing this unraveling issue, which leads me to my second suggested reform, which is overhauling risk communication. So folks in the room are probably aware, FEMA has recently overhauled the National Flood Insurance Program and its rate structure, its premium structure, in a way to better reflect actual household flood risk exposure. The reform that they're calling risk rating 2.0, if you're familiar with it. And in sort of a similar argument to the one I was just making about private insurers covering losses, risk rating 2.0 was sort of hailed as a way to shore up the fiscal solvency of the National Flood Insurance Program and better incentivize, in particular, adaptation in the housing market. What I'm showing you here is some on the left-hand side, some results from recent work by Philip Mulder and Carolyn Kowski that actually looks at some of the impacts that risk rating 2.0 has had in its first year of rollout. It's only been about a year in force for which they're able to observe data. And they find that risk rating 2.0 did dramatically shift flood insurance premiums towards risk-based pricing. But they argue that the black box nature of the underlying hydrological models that are driving risk rating 2.0, that are giving much better, actuarially fair property-based risk assessments, sort of shroud some of the key risk communication features of the old NFIP rate setting structure. So in particular, the while risk rating 2.0 overhauled the rate structure of the NFIP, there's still a continued reliance on outdated flood insurance rate maps as sort of the main source of publicly available flood risk information, which is limiting the effectiveness of these changes, they point out. And it's something that is hard to sort of tease from the data that's available at the moment, but certainly I find a plausible argument here. So in this point about, the how we communicate risk being important isn't necessarily just about making efficient insurance and adaptation decisions. There's actually a key equity piece to this as well. In some of my own work with Carolyn Kowski and Ollie Wing, we examined the potential for access to private information not reflected in the NFI premium rate structure that actually predated risk rating 2.0, and how that influences household decision-making about purchasing flood insurance. And we found that both outside and within FEMA-mapped 100-year floodplains, the impact of unmapped risk on both the probability of a claim ex post and the probability of taking up insurance is much stronger among high-income households compared to low-income households. And we see this as suggesting that high-income households might have differential access to risk that's not expressly communicated in the FEMA flood maps. And so getting risk communication right actually has a really important equity implication as well. So before I conclude, I think I'm just about at my 10 minutes. I'd like to sort of step away from the insurance context for a moment. And, of course, as a participant in this panel, I think overhauling premium structures and effectively communicating risk as sort of key objectives for insurance reform in the face of anthropogenic climate change are quite important. It's pretty clear that solely focusing on managing impacts of climate change through insurance is not going to be necessary, is necessary, but is not going to be wholly sufficient. So in particular, I think large-scale investments in risk reduction, as opposed to solely focusing on risk management, are going to play a pretty important role. And so in some ongoing work with a co-author, Joe Aldi, we examined some key equity and efficiency questions around these kinds of public large-scale investments in climate adaptation. In particular, we focus on historical investments in flood risk reduction through the construction of Army Corps levees. And we find that though these investments confer quite substantial private benefits in the form of reduced flood risk to protected households, they impose pretty large adverse spillovers to nearby unprotected areas. They're effectively pushing floodwaters elsewhere. So in a lot of these cases, and this is what I'm showing you here on the left-hand side, we actually estimate that these spillovers are so substantial that these investments have benefits that aren't, in a lot of cases, exceeding the costs of construction and the costs of these adverse flood risk spillovers. And so it turns out a key part of the story here, why are they still being constructed, is the fact that many local jurisdictions who benefit from the protection these projects provide don't necessarily internalize these costs. And so sort of the broader point I want to end on is that insurance market reforms, though important, are not a silver bullet, and other policies such as large-scale investments in risk reduction are also going to be important, but as we find in this work with Joe, are not without substantial issues. And so I'll advocate for an all-the-above approach, but emphasize that careful consideration of incentives and behavior at both an individual and institutional level are going to be key to getting the policy design right here. So I'll go ahead and close there, and look forward to some of the comments from the other panelists, as well as the Q&A and discussion to follow.
Great, thanks, Jacob. I think we have time for just one question, which we've kind of already queued up amongst the conveners, which is, what are your reflections so far on the early effects and outcomes of risk rating 2.0 and kind of just move towards actuarial risk pricing or risk reflective pricing? And what are kind of some of the potentials for that to spill over into the private, property market, given all the pushback that has kind of come along with our 2.0 and this black box model of actuarial pricing?
Yeah, I think it's a great question, and it's a fantastic setting to sort of look at how the first reform I really was trying to hit on is playing out in a real world setting. I think, first it's important to note that there are some key, as sort of a third-party external researcher and as part of the third-party research community, there's some key data limitation issues with the National Flood Insurance Program that sort of limits our ability to say with a lot of certainty what the main impacts of risk rating 2.0 have been. I think Philip and Carolyn's work is great in that it's documented. Risk rating 2.0 is in fact working. We're getting a shift towards actuarially fair pricing in a lot of places. We're also seeing premium decreases in a lot of places where perhaps households were given the coarse nature of the old rate structure, were paying more than they should be. I think the main piece that I think Carolyn and Philip hit on, and something that I see as quite important, is the fact that we're still relying on these outdated flood maps to communicate household level risk. And, there are a lot of third parties, like, for example, the First Street Foundation and other entities that are working really hard to try and better communicate, property level risk measures. But really, these flood insurance rate maps are kind of and how they interact with a lot of regulation at state levels, requiring disclosure of flood risk at the time of property sales, I think are really the main way we're communicating risk. And I think what's clear from Carolyn and Ollie in my work is that there are households that have better access to more granular risk information than what's included in those rate maps. And so getting that information, providing that information publicly, I think is going to be pretty important to ensure that these reforms are having their full effect. So I'll stop there. I'm sure we'll have time for some more discussion about risk rating 2.0.
Great, thanks. I think we're gonna shift to our next speaker, which will be Ian Gray.
Sorry, I shared my screen but couldn't find the unmute button. So now we're good to go. Okay, great. Well, thanks again to the organizers, to Emelina, Hannah, and Alex. I think there's a lot of interesting overlap between what Jacob just shared and what I'll share, although from a very different perspective. And I will, let's see, I will just dive into it. Okay. So I'm an environmental and economic sociologist, and I study how climate change, and particular concerns about impacts from climate change, are seized on and understood as economic problems. And this is done through a process that I call making climate knowledge actionable, which is the social transformation and inclusion of knowledge about climate impacts into the production of both public and private sector goods and services. Actionability, this process of translation, as my research shows, raises all sorts of political questions. For whom, for instance, is climate knowledge being made actionable, and with what kinds of distributional consequences in terms of access to essential goods and services? I'm currently writing a book about all of this, and one of the chapters focuses on the catastrophe insurance in the 2004-2005 hurricane seasons on the US Gulf Coast. And this is really the historical moment for me when insurers first started to grapple with climate change, and to grapple particularly with two problems: that past data will no longer be predictive of future losses, and that previously insurable places will become increasingly uninsurable. Now, I think most of you are probably very familiar with these dynamics, which have only intensified in the past few years. But just to summarize quickly, with the changing climate, insurers are under pressure to develop forward-looking risk estimates. However, pricing risk based on knowledge about the future deviates from traditional actuarial methods. The lack of credible ways of estimating future-oriented risks creates tensions around rate making, which we just heard about, forcing regulators to balance the need to maintain viable insurance markets with concerns about fairness and equity in pricing. Now, in this short talk, I'm going to revisit the moment after the 2004-2005 seasons, which really seems so long ago now, but where I identify insurers as first trying to make climate knowledge actionable. And the way the industry, regulators, and homeowner advocates responded to this moment continues, I argue, to resonate and shape our current situation, pointing to potential lessons about how the insurance sector might participate more proactively in efforts to reduce actual vulnerability rather than focusing increasingly on complicated ways of transferring increasingly untransferable risks. So much of what I'm going to talk about today, particularly the establishment of a stable wind insurance market, arose in the aftermath of Hurricane Andrew. And Andrew, which I'm sure I don't need to remind this crowd, drove a lot of innovation around both transferring and mitigating hurricane risks. But it also propelled the use of a technology called catastrophe models, or CAT models, into the heart of insurers' rate-making practices. These models, developed by third-party companies, use computer simulations to generate tens of thousands of plausible synthetic storm events. In the aftermath of Andrew, the models demonstrated they could better integrate tail risks into insurers' loss estimates. This provided a justification for increasing premiums that would also hopefully prevent the rash of bankruptcies that Andrew caused. Adopting CAT models into insurance pricing led to significant increases in coastal premiums, drove a major expansion of the role of reinsurance in coastal homeowner markets, and also spurred the development of insurance-linked securities. At the same time, confidence in these models helped stabilize insurance in places like Florida and prevented a collapse of the booming real estate market that's also so important to the state's economy. This confidence around pricing catastrophe risk held for roughly a decade, I would say, until the 2004-2005 hurricane seasons. These two seasons, as most of you are probably aware, also produced 7 major landfalling hurricanes. And while 2005 looms large in our memories because of Hurricane Katrina, it was really the combined seasons that created so much angst in the sector. And angst in particular, that the clustering of strong storms was a sign of worse things to come. Receiving pressure, particularly from the reinsurance companies, according to my interviews, CAT modelers tried to adjust their models to do something they were not originally built to do, which is create forward-looking risk estimates. New estimates produced through climate-enhanced models, especially those designed by the company RMS, suggested that Florida, for instance, was facing a 45% higher chance of being hit by a major hurricane in the next 5 years. Untethering risk from past experience, however, caused a severe backlash amongst consumer advocates, state representatives, and even science associations. And this backlash came in 2 different forms. The first is what I call an epistemic backlash. And what I mean by this is that there was no credible way to actually model climate-enhanced catastrophe risk on the scales of time and geography required for setting insurance rates. The CAT modelers like RMS or AIR were experimenting, looking for the best science they could find, but their initial approaches raised a lot of eyebrows. The second form of backlash was what I call a moral backlash. People were upset about the proposed price increases, of course, as for all the reasons people hate higher prices, but they're also blindsided by how these new estimates emerged in their lives, without any consultation or consideration of how climate-enhanced views of risk might upend their access to insurance and their sense of financial and communal security. And this quote from a letter that the Consumer Federation of America and the Center for Economic Justice sent to the National Association of Insurance Commissioners at the time captures both of these sentiments. They write that the 5-year approach is the complete opposite of that promise by insurers when these models were first introduced. Consumers were told that after the big price increases in the wake of Hurricane Andrew, they would see price stability. This was because the projections were not based on short-term weather history as they had been in the past, but on very long-term data, 10,000 to 100,000 years of projected experience. Now, I don't really have time to get into how the modelers brought climate science into their hurricane model at this point, although I'm happy to do this in Q&A, but the backlash led to a loss in the trust in the models. Many coastal states moved to explicitly ban these climate-enhanced risk estimates. And South Carolina's Department of Insurance issued a rule in 2014 that is exemplary in this regard. It states that the department does not permit the use of any of the following model variations: short-term, near-term, medium-term, warm phase, warm water, et cetera, et cetera. Only the long-term variation of catastrophe models is permitted. And these laws, as far as I'm able to gather, are still mostly in place, banning inclusion of climate change in rate making for wind peril. The result in places like Florida after the 2005 and 2004 seasons is that insurers were not allowed to increase premium rates to the level suggested by new models. And so many of the large national insurers began leaving the state. This withdrawal pushed many homeowners into the residual market called citizens insurance, making the government not just the insurer of last resort, but also the single largest insurer in the state. And we can see this explosion looking at citizens policyholder data, which Jacob also showed earlier, but this goes back to 2004. And it really leaps up after 2005 and reaches a high in 2011. And the state really slowly kind of sheds this exposure by helping fledge a Florida-only domestic insurance market that is more heavily dependent on reinsurance and catastrophe bonds in other state markets. But the limits of this short-term fix are clearly on display as the market is once again going off the rails after several seasons of bad storms. The most recent projections on the far right of this graph from Citizens are that by the end of the year, they will be providing coverage for 1.77 million policyholders for a total insured value of around $650 billion. This is far surpassing the record from 2011. So clearly, this insurance model is not sustainable. So what can be done, and how to think about the role that insurance has to play in supporting actual adaptation or engaging with ideas like managed retreat, the theme of this conference. So I agree with Jacob that prices have to increase. I don't really see an alternative to that either. But the experience from 2004, 2005, and from even more recent storms also points to the need for ongoing institutional innovations. So for the sake of discussion, I'll point to 4 here, none of which are uniquely my ideas, but which I find intriguing. I think there's a need to create more credibility and transparency in how insurers are developing and using forward-looking risk estimates. So this dovetails with what Jacob was saying around risk communication, I think. There's really currently no institutional space, at least that I'm aware of, where different stakeholders can gather and talk through scientific advances in CAT modeling and the impacts those advances might have on issues of insurance affordability and accessibility. This space should be created either at the national level by the Federal Insurance Office, maybe at the NAIC, or added to the mandate of a state entity, such as the Florida Commission on Hurricane Loss Projection Methodology. The President's Council of Advisors on Science and Technology recently wrote a report on improving extreme weather prediction, and they suggest really similar things. And this report is a really inspiring read for anybody here if somebody worked on it. But none of that explicitly includes convening different insurance market stakeholders to explore and co-produce more agreement on the nature of risks facing insurers, their customers, and municipalities dependent on insurance to secure local property tax receipts. Second, I think there needs to be more done to figure out how insurance might be used to incentivize community-level risk mitigation investments. As everyone here likely knows, adaptation funding is obviously very tricky. It doesn't generate real revenue and depends largely on public financing. But there are really interesting ideas out there from people like Carol Lukowski, who I know is attending this conference, about developing frameworks for community-based catastrophe insurance. And I think CAT models have a key role to play in making these ideas a reality. Third, there's a need to address duration mismatch. Duration mismatch is a kind of temporal slippage between the 2 primary financial instruments involved in homeownership, mortgages and residential insurance. You usually can't get one without the other, but insurers can back away from their policy commitments within a year or 2, while mortgages obviously operate on much longer timescales. And as we all know by now, mortgage risk is really a systemic risk. Now, at the moment, while insurers and reinsurers use longer range risk forecasts for business planning, they have little incentive to share the use of this information with other insurance-linked actors. The lack of insight into insurers' long-range planning is setting up reasons for more duration mismatch in the future, which ultimately contributes to the declining fiscal health of both mortgage lenders and municipalities. So again, I think there's a need for an institutional entity responsible for looking into this. Because of the systemic nature of duration mismatch, this could maybe be considered a matter ripe for the Fed or, again, the Federal Insurance Office. And finally, to prevent the growth of future candidates for managed retreat, it seems clear that there needs to be more constraints on local development. And there's a lot of ideas about how to do this, but I see that I'm also constrained on time, so I think I'll just leave this point at that. I guess I'll end there, and thanks, and looking forward to the conversation.
Thanks, Ian. I'm wondering if you could talk a little bit more about some of the federal level policy opportunities or levers that can, be pulled upon to instill or instigate some of these reforms, especially on the risk communication side of things and forward-looking CAT modeling. Yeah, so I think obviously the federal government is constrained in what they can do in local insurance markets, particularly on rate making and the regulation of solvency of insurers. But
I think there may be three levers to think about. And one is more related to land use plan and adaptation. But I think access to federal disaster aid or adaptation funding is a way that the federal government can kind of spur and strengthen, building code and land use planning, which obviously has effects on strengthening the health of insurance markets. So, not just dispersing funds without some kind of improvement in the way in which the built environment is planned around locally, which has been a kind of a tricky thing to make happen. I also think another tool that the federal government might use is the threat of a systemic financial risk. So it's, again, this idea that Jacob already brought up, that insurance is kind of a canary in the coal mine. And so this could be a way to open the door to regulatory actions that are already granted to the Treasury or the Federal Reserve under Dodd-Frank, or simply through the Fed's supervisory mandate to ensure broader financial stability. So I don't know exactly what this might include, but it could be things like requiring mandatory disclosures of previous losses from home sales. So to kind of fix some of those asymmetry imbalances information that Jacob was talking about, maybe that's actually something that could be promoted through that kind of venue. And finally, I think there's also a lot of other ways that insurance can be organized, and we could look to other countries and how they do it at a national level. And so I can think of France, for instance, which has a national reinsurance fund called the CRR, and every household in France pays a small disaster surplus on their homeowner policy, pegged to the value of their homes. And when there's a natural disaster, the president declares a disaster, and so the fund can be accessed. And so there's a lot of cross-subsidization and kind of this concept of solidarity in the way that the French handle catastrophe risk. Of course, this is something that competes with private reinsurance companies, and so it's not beloved by the private reinsurers. And this would take like an act of Congress or something. But I think there's other ways we could think about how insurance as an institution is a very national and kind of cultural-based institution. So we could think of looking to other places for lessons on how to maybe reorganize things differently.
Thanks so much, Ian. And we'll open up the end for a broader question.
Great.
All right, next up we have Clay Kertel.
Hello, good afternoon, everyone. I'm happy to be speaking with you all today. I'm sorry I couldn't be there in person. I'm presenting from Los Angeles, and I will be talking about insuring wildfires in California and, more broadly, managing wildfire risk and building wildfire resilience. I am a disaster recovery specialist with the California Department of Housing and Community Development, and our primary role is to administer long-term recovery dollars for California. Even though we just experienced, an unusually, wet and cool, winter and spring with pretty historic precipitation and flooding, climate whiplash in California means that California's, inclination to fluctuate between wet and dry periods is intensifying. So even though we had this, wet year, an intense wildfire season, and associated losses could be, just around the corner. So, if for folks who, aren't completely familiar with, the wildfire impacts in California, they have become considerably more extreme, especially within the past 5 years. Since 2005, wildfires have destroyed over 64,000 structures in California. But the real risks are, what are all of the structures that, haven't burned but are still in harm's way? In the sort of broadly construed wildland urban interface, some estimates place 4.5 million homes in this zone. A more specific policy definition is the fire hazard severity zone, which CAL FIRE, the California Department of Forestry and Fire Protection, designates as many as 3 million homes are in this, fire hazard severity kind of hazard exposure zone. But these are just hazard exposure areas, not, they don't, register risk in the same way that insurers would be looking for. So the partners at the First Street Foundation find that by 2053, about 66% of structures in California will be at, heightened risk for wildfires. So, it is a statewide issue, and as the, largest, housing market, property real estate market in the country, perhaps a issue of national consequence. Additionally, there are, equity considerations to these wildfires. In recent years, 41% of impacted residences have been rentals, which counters the narrative that we often hear about more affluent wildfire exposed properties. And a recent March 2023 paper from Miyuki Hino at UNC Chapel Hill and Christopher Field at Stanford indicate that while communities with the highest wildfire hazard exposure are more affluent than the median, wildfire disaster experience communities are less affluent than the median, which implicitly draws the connection between income and success at wildfire management and suppression. So amidst this brew of factors, there are challenges to the insurance market. First and foremost, growing losses from disasters and the heightened risk of more and more vulnerable development in these high fire hazard areas. While 97% of California property policyholders are still in the regulated or kind of we call it the admitted market, but that's what's regulated by the Department of Insurance. Fair plan participants have doubled since 2018. This is about 200,000 in some policies, and it's still below 3% of the market, but it's growing significantly. Insurers are facing pressures from heightened losses, rapidly rising construction and replacement costs, and growing reinsurance costs. So they're being squeezed both by limitations on their ability to raise insurance rates in the admitted market, and growing costs for reinsurance and replacement beyond what are being lost in wildfires. I think this is just the high cost of housing and labor in California generally. And I think there is an indication that there is growing understanding among policyholders that their insured amount might not be sufficient were there to be a disaster. Since 2018, the admitted market premiums have grown from $8 billion to $12 billion. And that's largely attributed to the growing cost of reconstruction. As a price point, in HCD's Community Development Block Grant Disaster Recovery Program, we provide up to $500,000 subsidy for a single family unit, but replacement cost for a modest home for low and moderate income residents is typically higher than that. And with a $500,000 subsidy, they can still face shortfalls. I do want to acknowledge that it's been in the news that two of the largest insurers have halted writing new policies for properties in the state. Certainly growing losses are a factor in that. But there could be additional factors, including rising reinsurance costs, financial market volatility, including rising interest rates, and the insurer's reliance on investment income could mean that the company is edging towards its capital limits that could then trigger higher regulatory scrutiny by the Department of Insurance. So there could be a range of factors that are more complex than simply a price and risk mismatch. But certainly that is an additional I think insurers see that as an opportunity as in this particular moment. Because of Proposition 103, which was a voter referendum passed by voters in 1988, as was mentioned in a previous presentation, regulated property rates are, kept low, are suppressed in order to protect consumers. And California, kind of falls in the middle of rates nationwide. Additionally, subsequent regulations mean that insurers must, when they want to increase rates, they must look at historical losses rather than looking at catastrophe models or reinsurance cost pass-throughs. This means that rates can rise more quickly in disaster-impacted areas because the historic losses are a factor that they're able to consider. But areas with very high risk, but without disaster experience, wouldn't be able to see the same kinds of rate increases. So now shifting in the latter part of this presentation, shifting to what some solutions might be for managing this risk and in the insurance market. Insurance is just one of many tools to build resilience and reduce risk and support recovery from disasters. And so I think insurance is seen as one of these tools in the toolbox, but there are a lot of other partners and stakeholders that need to be activated in a new and more aggressive way in order to reduce the underlying risk. For market stabilization, insurance regulators could allow the use of forward-looking catastrophe models or the cost of reinsurance to inform rate setting. But it's unclear to us that by increasing rates and signaling more risk accurate rates that people would have more coverage. I think the likelihood is that some of the most vulnerable residents would simply lose coverage, transferring risk from insurers to government disaster recovery programs. So I want to emphasize the range of tools and strategies that are necessary to fundamentally bring down wildfire risk. And this ranges from land use planning at the jurisdictional level, enforcement and adoption of building codes, defensible space regulations that could, statewide, but also enforced by jurisdictions, increased hazard mitigation programs and funding especially to fill in gaps in lower income and more vulnerable communities where the capacity and resources may not be as available. And then activating federal partners really in landscape scale forest management, because most fires are triggered in the wild, start in the wildlands. And even if that's not under local authority, it still impacts their risk. So 3 of the planning pathways, likely a combination of the 3 is, more building as usual, more sprawl in the wildland urban interface with less affordable insurance. I don't think there can necessarily be uniform application around this state with, kind of strong local land use authority. But there can be greater investments in resilience in place, in enforcement of home hardening, defensible space, and fuels management requirements. And then also an opportunity for some, intentional relocation through planned hazard mitigation and long-term recovery programs. But in a state that has a 3 million housing unit deficit, this has to be complemented by expanding housing supply in lower risk areas. And I think any conversation about wildfire and climate risk in California has to be complemented by housing supply and affordability solutions. For the sake of time, I'll just conclude on this long list. I recognize the text-heavy slide, but I think it captures the full range of solutions that are necessary to meaningfully reduce risk and build resilience in California and in other wildfire prone states. A lot of these are similar to, flood risk management strategies, but I think in a different context and, with a different level of, data. So, we have, for example, we have, statewide kind of a patchwork of hazard exposure maps through this fire hazard severity zone, but these are not risk maps. So issuing clear statewide hazard risk maps that can be, tied to policy, I think would be an important tool, recognizing that itself is a, highly political and challenging step. And I think also importantly, leveraging disaster recovery and hazard mitigation programs to support redevelopment, home hardening buyouts for vulnerable populations. And bringing down housing construction costs, I think, is also an important aspect of the cost of of hazard risk. Whether that be through streamlining environmental review, cheaper materials, or less expensive design, or more permissible inclusionary zoning practices for cheaper housing supply. So that concludes my presentation. Thank you so much for listening, and if there is time for any questions, I'll be happy to answer.
All right, okay. Our question to you is, the news has really been focusing on the causes and effects of insurance exits from the state, but I know in your role, you've been working to really bring attention to the issue of under-insurance in California. So for people who already have insurance, that broader issue of under-insurance. So what could be the repercussions of not focusing on under-insurance, and what role is the state playing in trying to start addressing some of the mismatch?
Yeah, underinsurance has been proven very tricky for disaster recovery purposes. Because when FEMA comes in after a disaster, if you have insurance, they're going to look at you and not deem you to have unmet recovery needs. So that then shapes what the HUD CDBG-DR allocation would be, because those insured properties aren't going to be factored into a disaster recovery funding allocation. So that's been a major challenge for Western states, and why you see despite the disaster losses, the federal resources made available are relatively smaller. But at an individual household or community level, there needs to, I think part of it is greater awareness and understanding of what your replacement costs are going to be, because while like a $300,000 policy may have worked 10 years ago, it probably won't today. And insurers aren't required to update those policies. That and a consumer has to increase the amount of insurance that they would like to purchase on their own. And so there's an opportunity for community groups like fire safe councils to do a lot of community engagement and education in areas where folks may be underinsured. In the number of residents who have homeowners, property owners who have insurance is in the low to high 60s, typically county by county, low to high 60%. So there still is a significant gap of folks who are not underinsured but uninsured completely. And then among the insured folks, about 2/3 of them find themselves being underinsured in a disaster.
Thanks so much, Clay. And finally, we have Rachel Young, who will present next.
We're back in person now.
Yeah.
Great. Hello, all. My name is Rachel Young. I'm a PhD candidate at Princeton University in the School of Public and International Affairs, advised by Professor Mike Oppenheimer, who is in the audience here today. So thank you all for having me. I really appreciate the opportunity to present for you all. I'm going to take us a little bit away from insurance and give you sort of an overview of the main findings in my dissertation work, but I think that my findings really motivate why insurance reform is very important, and some of the new kind of programs that are coming out can help us move into a more managed retreat kind of mentality. So natural disasters trigger a complex chain of events that impact human society across wide spatial and time scales. This is just one image from Hurricane Ian in Fort Myers Beach, Florida, and Hurricane Ian hit Florida last year in 2022. And you can see the very obvious physical damage on buildings and property, but there are more persistent economic effects of these kinds of disasters that can scar communities long after these the debris is removed and the buildings are rebuilt. So in a paper that I'm co-authoring with Professor Solomon Shang at UC Berkeley, we perform a large-scale evaluation of the long-run impact of tropical cyclones, which includes hurricanes and tropical storms, on human mortality in the United States. And this is just the main figure from that study. And it is the cumulative excess monthly mortality following a tropical cyclone event. So using the quasi-random variation in the tropical cyclone location, timing, and intensity, we're able to use regression analysis to construct a response curve for a tropical cyclone on mortality effects. So this is deaths per 100,000 per meter per second exposure of tropical cyclones. And you can see that this is over on the month time scale centered at 0, which is the month of the tropical cyclone event. And you can see there's persistent effects and an elevated amount of mortality driven by these events for up to 15 years after they occur. And this is on all-cause mortality. And so we use this model and we were able to reconstruct the historical excess deaths that we can see from the past, from 1930 until 2015. And then we summed those all up and we found that tropical cyclones are attributable to up to 3 million excess deaths in the United States. And that's about 3% of the total mortality that occurred in that time period between 1950 and 2015. So this is a very large effect that's not captured in NOAA's direct accounting of how much tropical cyclones and hurricanes are harming human society. This is going far beyond those kinds of estimates where NOAA says on average is about 24 deaths per hurricane event. So given that there is this mortality effect and other studies have shown that there are long-run economic impacts of disasters, we might think that people might want to move away. There's like a self-insurance option where you can move away from these high-risk areas, but the data doesn't really show that. So we can see, and this is, we're at a managed retreat conference, so this should be no surprise for the folks in the room, but just using sort of county level moves from the IRS matched with a very popular Shieldus database of county level disaster exposure, you can see that this is just the effect at the time of the disaster on the likelihood of moving out of your county. And the effects are persistently 0. This is across a variety of different effects. And I have this in event study, and you can see the pre-trends, they're very flat, and the post-trends are very flat. People are not on average moving. And you can think about, Hurricane Katrina and Hurricane Maria, where you do see mass out migration and the populations are declining. But for every Hurricane Maria and Katrina, I can give you a counterexample where people are not moving. So using machine learning techniques, I was able to do a building level analysis of the level of damage at property level in Houston following Hurricane Harvey. So here I'm just plotting for you Texas, and you can see the wind swath. So this is the wind speed exposure from Hurricane Harvey. And then that blue kind of area, which is difficult to see on the screen.
You're not sharing it on Zoom, sorry. Back to Zoom. Which one is it? Sorry to interrupt you. I had to do that real quick. Sorry. Back in the slide mode. It's blocking. It's blocked. Which? Yeah, this was blocked. Let's see. All right. Now you're good.
Great, thanks.
Sorry about that.
No problem. So you can see here that the blue area here is the intensity of the wind swath, and then I showed you also the rainfall area from Hurricane Harvey, and all that big black chunk is just the pixel, is the polygon level is the polygons where we had the aerial imagery pre the Hurricane Harvey exposure and post Hurricane Harvey exposure. And then we were able to use machine learning to estimate the level of damage at the property level. This is just a zoom in of a particular area, and you can see the individual properties. The color just corresponds to the level of damage at each property level. And given that this is property level data, I was able to take the addresses that correspond to each property and match them with a consumer reference database that shows individuals in the United States addresses over time. And that way I can see what was your level of damage after you were impacted by Hurricane Harvey, and then where did you go? Did you move, and where did you go afterwards? And so once even accounting for the level of damage, when you compare the effect of Hurricane Harvey on the likelihood of moving to just a different address, adjusting for level of damage, we see no effect. And this is relative to a comparable control group, but Hurricane Harvey was not inducing mass outmigration. So this tells us that there might be instances where it is efficient and equitable that we want to pay people to move. And I know there's a session on buyouts that is parallel to this session, so apologies for that. But just to give you a taste of some of the work that I've been doing, we did, using that same consumer reference database, I was able to identify who was participating in the FEMA buyout program and then figure out where they're moving over time. And so this is for all FEMA buyouts that occurred between 2000 and 2015. And this is just showing you relative to a comparable control group. And it's important that we have a control group because we want to estimate the average treatment effect, because people are also just moving on their own without the buyout program. You can see the increase in the likelihood that you are no longer living in the special flood hazard area, which is the 1% annual chance flood hazard area that FEMA maps out for us. And you can see there's a significant increase in the likelihood that you're moving away from these higher risk areas from time event 0 to 5 years after the buyout occurred. And that is just very consistent with the amount of time it takes for the buyouts to kind of go through the entire process. And then that effect starts to decline. And this is because the control group is also moving away from these high flood risk areas. There's also an additional benefit of the buyout program, which is that it not only induces people to reduce their overall flood risk, but they're also getting an opportunity to potentially move to anywhere else they want to go to. And so I also wanted to do analysis comparing whether or not you're moving to a census tract that has higher income, higher educational attainment, and lower unemployment. And we do see that there is an effect. It's smaller than the overall moving effect, but relative to a comparable control group, individuals that participate in the buyout program are moving to areas that are slightly higher income at the census tract level. Unfortunately, that this effect is really a sort of a side benefit for a particular group of individuals. So when I decompose the effect of the buyout program on for those that are in high and low fraction Black census tracts, you can see that this bottom plot here shows the overall effect of moving to a new address and then moving to a higher income census tract. You can see the effect for those that are living in less than 50% fraction Black population census tracts, very consistent with the overall effect. But when you look at the effect on those that are living in greater than 50% fraction Black census tracts, not only are they less likely to actually move, but that sort of added benefit of moving to a higher income census tract is completely gone, which implies to me that the FEMA program could do a better job of actually targeting the people that are most vulnerable. And there's been a lot of work in the equity space on the effectiveness of the buyout program for different racial groups and different income groups. So this is very consistent with the current literature. So in conclusion, I just want to say again that hazards are having a long run economic, productivity, and health impact in the United States, and that migration is one potential adaptation strategy. It's a form of self-insurance, but we don't see a detectable level of moves after people experience a hurricane or any kind of natural disaster event. There's a couple of theories about why this might be the case. One is that insurance and that government assistance is sort of disincentivizing people from moving, creating moral hazard issues. Another is that higher wages and amenities and maybe just preferences to your origin location are offsetting any kinds of costs and any kind of risk that might exist in those areas. And finally, just that individuals that are living in these high-risk areas are trapped. They can't afford to move away even if they wanted to, which motivates that buyouts can really help people reduce their overall flood risk, and they can have some other additional benefits as well. But that it's really important to get that equity piece right, because we might be just subsidizing people who could have moved on their own without government assistance. So thank you so much for having me again, and I look forward to the questions from the panelists and the audience. Here's my contact information, and thanks.
Well, that was really great. So my question for you before we open it up to the rest of our panelists and for you guys to ask them questions as well is, it seems like your research is very data driven and pulling data from large databases, whether it's open source or proprietary. So I'm curious from your perspective, from regulatory sphere, what critical data is missing from these acquisition databases that exist or the NOAA tracking information that would really help agencies like FEMA and HUD and the broader public researchers track and monitor where households are going and weave in some of these equity considerations you brought up.
Yeah, so one sort of novel component of my buyout analysis is that we're able to match the consumer preference data, which is people's addresses. And that allows us to actually see where people go after they participate in the program. This is a thing that neither HUD nor FEMA really do. They don't, like in HUD, for example, if people exit the HUD program, they don't know where they go. They have some exit interviews that are kind of at the state level, but it's difficult to understand why people left and where they went. And same thing with FEMA. Like the FEMA buyout program historically has not tracked where people go. Their main mission is just to make sure that the properties are now open space. And so I do think that there's been a lot of initiatives at the federal government to try to do a better job at charter evaluation. So there's a series of acts, including the Evidence Act, which really centers evaluation of the effectiveness of the programs. But I think it's a really great start. Obviously, there are a lot of privacy concerns, especially amongst the federal government, about what they can make publicly available. I do think FEMA is relatively more open in their data sources than other federal agencies. And then so what my fellow panelists were talking about, there might be just some benefit to an increased accessibility on your actual risk. And there's a lot of discussions about about disclosure of past flood events or other kinds of hazards. So they all come with market signaling effects, but that kind of information I think is I know the federal government is pushing to try to make that more publicly available. Whether or not they can, no question, but I think they're moving in the right direction.
All right, well, now we have, I think, everyone here. And we on hand to put some view place here. So now we're just going to move on for the rest of the session to broader Q&A, broader discussion. So if folks have questions, I think protocol could be just to come up and ask them. So if folks want to queue up here and you can come up and ask at the microphone so that folks online can hear you, that would be great. But we're going to kick off the first question to all of our panelists here. So Jacob, in the beginning, you brought up the idea of one large reform issue with the price mismatch and having actuarially sound rates across the insurance industry. And that's something that I think we've seen at the state level, lots of lobbyists on the insurer side asking regulators to push for. But we also know that affordability is a huge issue and raising premiums will have real issues. And we don't necessarily have a lot of ways to means test some of the approaches for reform. So how do you see regulatory regimes carving a path forward on these kind of two often oppositional issues? And I'll just leave that for anyone to answer.
Sure, I'm happy to start out. I think there are obviously key political economy considerations that might limit the ability to implement one idea, which would be just to directly subsidize using disaster insurance, using some sort of means tested threshold to provide that subsidy. I think that's probably the most direct way to sort of marry an objective of actuarially fair pricing and these affordability concerns. I think there are a lot of other probably far more creative solutions that could also be implemented. And this is maybe a much broader point that extends beyond just the affordability piece. But I think there's probably some interesting opportunities for this would really focus at the state and local level, but for regulators to sort of free up insurers to make sort of relax some of the institutional barriers to more creative forms of disaster insurance. Perhaps like a regulatory sandbox, if you will, where different types of more creative products can be tested out. So, that might not necessarily directly address this affordability piece, but is something to think about in some of these broader reform discussions. But I'll let some of the other panelists jump in here as well.
All right. No one else has on this one. It's a tough one. All right. So Ian, yeah, feel free. Go ahead.
I'm sorry. I couldn't hear the question because of the microphone. I couldn't quite grasp what was being asked.
Yes, I can say it again. So the question is really around this tension of insurers pushing for regulators to relax some of the rules around premiums to have an actuarially sound rate universe, addressing some of the things that Jacob brought up around the price mismatch. But what role can regulators play to kind of carve a path forward with sort of the oppositional issues between actuarial sound rates, which will likely lead to higher premiums, and affordability issues, and thinking about equity concerns for insurance coverage?
I'll let that pass. I liked what Jacob said, so I think we can. Sorry about that.
Yes, we have a
Let's
question.
give a question from the audience.
Up here.
Yeah, I think that my folder. Can you all hear me on Zoom? Great. So I'm new to this space, so forgive me if my question is a little off. My understanding is parametric insurance isn't really viable in the US because of our history of private insurance. And so if there are states where the market's falling out and most of the insurance is being backed by the federal government, are there now more areas where parametric insurance might be an option for some low-income communities? Because I know pretty sure there's a project in New York City that's being piloted with NSF funds and I believe warrants. Thanks.
I can jump in and provide two different kind of pilot projects that I'm aware of in California. Parametric or community catastrophe insurance would be outside of the regulated market, so the state wouldn't have a role in regulating or monitoring that. But to the extent that the state wants to innovate solutions to filling gaps, there is an interest. One active policy I think is held by Los Angeles County, and it is for extreme heat events. And so when the extreme heat threshold is passed, then the payout can be used for emergency response activities. Maybe that's increased ambulance dispatches. That could be for increased capacity at cooling centers. Triaging, distribution of air conditioner units, things like that. But their application is really contingent upon on understanding what the resource gaps are going to be in the event of a disaster. I think I would agree that it's harder to use parametric insurance as a direct replacement for indemnity-based insurance because in part the cost of it and distributing those resources in a public way, a jurisdiction has a parametric insurance policy and then there are several hundred units that have losses that. It's very challenging how you would distribute those resources. But there is an emerging pilot in a farm worker community that was impacted by flooding this year. A lot of undocumented immigrants who would be ineligible for federal disaster recovery assistance. But in that case, a parametric policy could be used for temporary shelter assistance for residents who wouldn't be eligible for federal assistance that other people get. So those are kind of two examples that I'm aware of in California.
Yeah, and I'll just add, parametric insurance, for folks who don't know, is insurance where it's not traditional indemnity insurance, where you have a flood event and you have adjusters come to the home and assess the claims, assess the damages on a household by household basis. you're actually building an index and triggering payouts on usually third-party data. So whether that's stream gauges, whether that's satellite data, whether that's measurements on the ground, it's triggering the payments. So I think in some ways, this approach is a much broader approach. You can look at the community level. So, thinking about alternative ways of financing parametric may be a really good way to kind of scale the approach to watersheds or townships. So that's kind of one area where we could see this grow as we see these kind of classic indemnity insurers pulling out of states where they see individual property values. Yeah, would you like to go?
Any other comments? Okay. I have a question for the panel. I'm going to maybe starting with Jacob, because you commented that we should do lots of different options altogether, not look for one silver bullet. Okay, I'm with that. I'm in Michigan. I study Great Lakes coastal management on shorelines that are receding. It's not a question of if they're going to recede, it's a question of when. And in ocean coastal settings on shorelines with sea level rise, it's not a question of if this property is going to go into the ocean, it's when. And I understand with insurance, you really only insure risk of a episodic nature. You can't really insure inevitability. And I'm also worried about moral hazards. If we're giving insurance and making it available, we're encouraging people to build maybe where we don't want them to build. So when do we step back and say, you know what, this is a place to not offer insurance because it's going to happen, and insuring is just going to encourage it to happen in a way that the recession is going to happen. Do we really want to be encouraging people to build? So I wonder if you all could comment or think a little, or tell us what your thoughts are on that kind of tension. Does that make sense? Does that question make sense? Okay, thank you.
Yeah, I'll go ahead and start off. I think it's a fantastic question, and it really, I think, is an important one to be asking at a managed retreat conference. It's an issue that I think, in part, working towards actuarially fair pricing is going to be important to sort of help us answer this question. If we're thinking about settings in which insurers cannot recover the expected damages in these settings with truly rapidly evolving risks, such as the ones you mentioned, where perhaps there's in the limit we're looking at assets that need to be insured that have a value of zero, really. I think if we continue to constrain insurance markets from pricing at actuarially fair rates, we're only further incentivizing building up and remaining in these communities that face these kinds of existential risks. So, I think that's where we, in this particular context, why getting towards premiums reflecting underlying risk is so important, because we are sending better signals to individual households about what the long-term value of living in these communities is actually going to look like. But I think it really is an existential question, and it's a question that folks at the managed retreat conference are probably going to have more insightful answers for than I am. But happy to hear from other panelists on this one as well.
Yeah, I can jump in here and just add that I think there's going to be kind of a lag time in where specific geographies are coming into that zone of certainty in terms of going to be inundated chronically, maybe acutely, but where there's no risk to be calculated anymore because it is becoming a certainty. But I can think of interventions that at the state level are being made in places like Louisiana. So the Coastal Protection and Restoration Authority there is spending a huge portfolio of investments on trying to shore up eroding coastlines that are suffering from a variety of impacts, from pumping underground reservoirs of oil and gas, which is causing subsidence, but also sea level rise and other things. And so there is maybe a space, and I don't know if I'm encouraging this, but a space where investments by the state are perhaps prolonging the insurability of certain areas, and that prolongation is not being captured by the insurance sector necessarily. And so I'm thinking, that, and Jacob's actually your paper that's coming out on the spillovers of levees and dike constructions maybe goes against this point, but using something like a catastrophe model to do counterfactual analysis of how certain infrastructure might reduce risks and how that could be passed on potentially to insurance savings. I think that's a space where we could think about, what's the actual time lag or the lifespan of an area that's going towards uninsurability, and how can that be prolonged, or kind of how can an off-ramp be built, I guess, is maybe something I'm kind of thinking about.
Hi, Adam Sobel from Columbia. Thanks for the great panel. I'm going to take the liberty of two closely related questions for two panelists. So for Jacob, you had the interesting result that higher income households have access to private risk information, and I'm curious what that is, if you know or can speculate. And then the related question for Ian is, among your many solutions, one of the things you said is we could have, I can't remember the exact words, but a public discussion on the methodologies for risk assessment. Compare the CAT models, discuss them openly so it was less opaque. I think that's a tremendously important idea. I just want to share an experience. About 6 years ago, a few colleagues and I at Columbia tried to do this with some few friends in the insurance industry. And the problem we ran up against is that the biggest players in the CAT model space, the biggest vendors, saw it as against their interests. They didn't really want to do it because their view of risk is intellectual property that's proprietary, that's valuable for them, and any open discussion kind of devalues that, because if everybody has the information, then obviously it's less valuable. So it seems to me the only way to do it is either compel them to participate or do it without them, or to have a public ecosystem for catastrophe model, living in government and academia, which we don't have now. And so I guess the question is, do you have any thoughts on what's the most feasible way to do this politically and otherwise? Thanks.
I can take your first question because I think I can hopefully answer pretty quickly. So in that paper, the way in which we measured unpriced risk was using output from the First Street Foundation's National Flood Model. So basically what we were looking for is that are certain households more or less responsive to what the First Street Foundation flood model is measuring, which is I think it's no stretch to argue that that's far more granular than what's in the flood insurance rate maps and far more up to date than what's in the flood insurance rate maps. So our households responding in their insurance decisions to that unpriced risk. And so, while we aren't necessarily, and we did find that they were, we aren't necessarily arguing that these households are, going on flood factor, and that's, the main mechanism through which they're accessing that private risk. But we could imagine, that as a particular example of the types of things that higher income households have, knowledge of the existence of these external, resources about their property level risk, perhaps. So yeah, I'll leave it at that.
Yeah, great. And great to see you, Adam. And thanks for the question. I know you've worked in this space for a long time and run into these problems. So I think it's kind of hard to imagine compelling these actors to do these kind of consultative, convening activities like I'm describing. So I think one response is what you brought up earlier. This is what this recent report from PCAS, the President's Council of Advisors on Science and Technology, published recently is that, we need to develop a more robust public ecosystem of knowledge about loss data, hazard data. So kind of compete maybe a little bit, but maybe competition is not the right word. Maybe create a space where you're incentivizing the private modelers to participate. And I think as an appendum to those interagency committees that are called for in that report is you could imagine something that's a little bit more stakeholder focused, a little bit more interested in the co-production of knowledge, a little bit more interested in the communication of the kind of proprietary knowledge that these CAP modelers currently hold. I mean, I think the CAP modelers, corner on the market in some ways is that they have all of the loss data from all the insurance companies, which nobody else has. And so this gives them a perspective that didn't exist before CAP modeling existed. And so that's something that should become more and more public. And I think that's where there does need to be a much larger investment by NOAA and the NSF, and I'm not sure who else, but in producing some of that similar, perhaps rival knowledge. I don't know. I guess I'll leave it at that, and I'm sure we'll talk about this further.
Great. Yeah. I think we have time for just one last question. Since we've got about 3 minutes left. We have somebody else in the audience coming up.
Hi, thanks for all your great insights. I have a question about, well, a lot of what we're talking about is based on individual homeowners making rational decisions about their risk. And so if they understand their risk, they will buy flood insurance. But we know that most of the people in the United States who have flood insurance have it because they're required, because they have a mortgage. And most of the people, once they pay that mortgage off, tend to drop the flood insurance, or if the house has been in the family for years, they don't have flood insurance. So I'm wondering, is this enough for us to be managing risk from a policy perspective, or if we need some sort of expansion of the criteria that requires people to have flood insurance?
I can kick that off. I think it's a fantastic question. I think the data are a little bit challenging to pin down precisely what the right numbers are, but it's something less than 50% of households, in the FEMA mapped 100-year floodplain actually have active flood insurance policies, and there are a lot of, I think, great ideas about how to increase that number. And for folks who aren't aware, that floodplain delineation is where the requirement for households with a mortgage from federally backed lender to have flood insurance. That's where that mandatory purchase requirement applies. So I think there are a number of things that you could do to raise that number and increase individual household take up. One might be think about, and this is something I think Ian kind of alluded to, but think about the term of these policies. So FEMA policies are a year, but most households who have these mortgages are staying in their household more than a year. So extending the duration of how long the term of these policies might be one way to address this. I think I have some experimental work looking at how framing of risks can influence demand for insurance, and this is leaning more on sort of the behavioral science literature. I think this gets back to the risk communication piece and really paying attention to what are effective forms of risk communication, and where that can occur. Where households are interacting with the National Flood Insurance Program, such as through flood insurance rate maps. I think paying attention to those insights from maybe the behavioral sciences would be particularly helpful in addressing your comment.
I just want to jump on the risk communication side of things as well, because one major constraint for FEMA in providing more up-to-date flood maps is that they're tied to the regulatory requirement for insurance. So FEMA has a lot more information on flood risk across the country, but there's a ton of resistance to updating the flood maps that changes who's required to purchase flood insurance.
And so some kind of option where there's a federal governmentally funded, some kind of regulatory reform is required in order for FEMA to actually do a better job at communicating flood risk that's up to date, that's current, that can give people information without being tied to your requirements. I think really important. Because I think about 20, and my panelists can correct me if I'm wrong on this, but I think 20–30% of the people with flood insurance are actually outside of the required zone. So why are those people purchasing flood insurance? Great. Well, I think we're gonna have to call it there at the top of the hour. Thank you all for joining and participating for the questions that came from the audience. Thanks again to our speakers, Jacob, Ian, Clay, Rachel. Thank you so much for participating. It's been great to have you, and yeah, enjoy the rest of your day.